Today is the 4th of June, 2026, 11 in the morning, CET, and 5 in the afternoon, Manila time. This episode, we talk about Japan taking on new borrowing for oil subsidies, divergent capital flows in and out of China, and potential red flags in US convertible bonds. Hello to our listeners. I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgren, the founding CEO of Lundgren's Capital.
This is Sound Economies with Mel and Peter, a weekly East meets West podcast by Lundgren's Investor Insights. Join us as we analyze developments in major economies and financial markets globally.
Hello, Mel. How are you today, and how has your week been so far?
Hi, Peter. Happy June. So we're already in June, so very exciting times. We've been kept busy by I'm actually writing articles for upcoming magazine. So we're tackling China and the ASEAN region this time. So very exciting scene here in this part of the world, and it's kind of tricky to time it because a lot is evolving and some are not happening at the same time. And I'm saying that over the US Iran conflict. So we're always on the lookout as always. How about you, Peter? What's been keeping you busy?
Very busy. And among that is some business related to our own defense fund, involvement in defense investments in general, but particular from our perspective, our defense fund. So something is cooking there. I think next week we are so far that we can come up with. I think it's a very interesting announcement, and that is really taking the day and night.
Yes.
Good. If you're fit in China and the rest of the Southeast Asia, so in particular, why not start there as we go to the neighbor country that is Japan.
Yes.
Uh, they, they are on it again, Mel.
Yes, we've always talked about Japan in the context of very high public debt. And yes, they're at it again. They have just, I think it was yesterday, when the Japan government announced a $20 billion supplemental budget in the works. And that's mainly to finance additional or continuing gas subsidies due to the prolonged US-Iran conflict. So the $20 billion is mainly to continue the diesel and gas subsidies as well as liquefied natural gas because
Mm.
they also use that for heating and industrial purposes, which are all stuck along the Strait of Hormuz to this day. And this supplemental budget comes just a month after the annual national budget has been passed. So it's very it's a very big testament to how expansionary the fiscal policy is under Prime Minister Takaichi. That looks or sounds good for the GDP growth of Japan. Of course, more spending, more government spending is welcome. But at the same time, of course, it also means additional borrowing to finance that deficit. And that is a growing concern. Japan is already one of the most heavily indebted countries in the world. Their debt to GDP ratio in 2025 was already at close to 250%. So like nearly triple the size of the economy, and it keeps growing. This will definitely add to the pile. But what the government is saying is that it will be deficit neutral, this budget, because we are able to collect additional revenues anyway. So, but we don't really see that to be the case. Additional debt would always be a concern, especially for international watchers, and definitely for us. There are also discussions about the trajectory of interest rates in Japan. As we know, it was an outlier pre conflict of US and Iran because they were really hiking interest rates after a long, long period of zero or negative interest rates. But now they're trying to still make the case for a rate hike simply because they need to pull back inflation in and but at the risk of course, slowing the economy further and disrupting sentiment yet again on Japan. They were just trying to get back on their feet, and then here comes another black swan event in Trump's attacks on Iran. So that is a concern, and that's also something that we're watching out for later this month. And we also watch out for inflation. It is rising as well, as in its neighboring countries, but additional subsidies would kind of temper this price increases, but it will be very costly as far as the fiscal position of Japan, and yields are already higher on Japanese government bonds. So much so because there is growing nervousness about why are we borrowing again? Why are we borrowing so much this quickly? So we see that it builds up on the already very high debt burden that of course investors do not look kindly upon.
Yeah, it is in line with what we have raised concern about a new expansion within public debt, but
Mm-hmm.
now as the markets are also concerned about it, and that is of course what we observe, another engine behind rising rates. Yeah. The spending might support the stock market short term.
Yes.
That's an absolute possibility. We will not neglect that factor, but a bit longer, the rising rates will probably become a bigger sort of headwind for the stock market.
Mm-hmm.
So that is what is going to happen. After some time, it'll be negative. Again, we can only say this is very important for investors actually. Sneaking in as the only solution all across the world, yeah. To do a bit of, yeah, I will do a bit more of a sort of a depth thing, yeah, and then we hope things work out. They won't. So that's Japan. Let's
That's right.
jump to the other side, to the neighbor country, China, and circle around a couple of stories actually, interesting stories, basically very much concerning to investment flows. Yeah.
We have quite
Yeah,
opposing directions today.
exactly. Do we have good news, Mel?
Yes, let's start with the good news, of course. So actually, two major global banks, asset managers as well, are increasingly reporting that more of their clients, both on the institutional side as well as the family offices that they service, are being more open or being more active in taking bigger positions or strategic positions by acquiring more Chinese assets, rebalancing their portfolios, taking some from their US pile and shifting it towards emerging markets, particularly Chinese equities. JP Morgan recently did their Global China Summit where they surveyed about 3,000 clients that they had, and the survey showed that 57% of investors are already looking to invest in Chinese assets. That's up from 51% last year, so it's a steadily growing share. Basically, they want to ride on the tech and AI growth in China at very cheap stock prices. We've often said that Chinese stocks remain undervalued, and we like that because it's very attractive. It offers bigger returns. It applies to both Hong Kong and Chinese stocks. That uh, research is good, progress is good, cheap costs of operations as well. So that's why they see a big upside to investing in Chinese tech stocks versus their US counterparts. Actually, the Shanghai Composite is up 20% year on year. It's very interesting trend while the rest of the world is kind of very jittery. There is a strong trajectory in China stocks. UBS is also reporting that more family offices are reallocating their portfolios to accommodate more Chinese assets. Um, while they're mostly still taking a North American base of assets as their main, I guess, the biggest share in the pot, they're trying to allocate more and more to China. Although they cite that geopolitics and higher debt, public debt are the main threats that they're watching out for. So maybe that's why they like China more than Japan, as we talked about. And there's also this expectation that the dollar's reserve status could be weakening, and we're seeing that already in the recent days. There is greater activity or shifting towards gold, and China's panda bonds offer is getting really popular globally. So that is a manifestation of that as well. Taken together, we see that this trend of decoupling away from the US and towards China is going to continue. It's going to pick up pace very fast. And these reallocation strategies may be good, especially when you want better returns, strong returns, and when you're starting out to invest really cheap. That's really a strong value creation for your investment. And this is why we have our own China fund. That's the very reason we see it. And it's like more people, more investors are noticing what we saw a few years back, Peter.
We are so lucky to have an award-winning China fund here in Mars. We can confirm there's a growing interest to look into to Chinese stocks, absolutely. And it makes good sense. You have mentioned several times. We consider them as actually being cheap. Belongs into a diversified portfolio, first of all. And now they're also gaining more interest due to the AI part
Yeah.
of the Chinese
Mm-hmm.
stock market. As we have two stock markets in the world that can offer anything sort of meaningful within AI, and that is the US and the Chinese stock markets. There are good reasons to look into it. So we can confirm that, having
Yes.
as also based on what we see and interest and conversations about our China fund. So that's not bad. It's truly interesting and it is growing. Also an overseen investment destination the past years. Again, this is sort of a typical Chinese story. Sort of the Chinese domestic investors. Uh, they are fantastic to jump on a wagon, and if something is possible, they do it. And
Yes.
and and that's you find it across the Chinese society. It's not only investor behavior. And there's a crackdown going on right now among some brokerages and investor accounts. And what's going on is some brokers are utilizing sort of a loophole to facilitate investments outside China. The way to for Chinese investors to invest outside China is to trade via some what we call official trading channels. They are
Mm-hmm.
north southbound, actually from originating from trading in and out of Hong Kong. So there's a regulated way to trade and get into to foreign assets. And this is not so much to do with the control of the individual person at all. It I would say it has much more to do with
Mm-hmm.
currency control, basically. So this is the most important part of the story. But a lot of brokers, they have found a loophole so they can offer uh, private investors sort of access to foreign stock markets without this going via the true and official trading channel. And that is now getting blocked by the Chinese government, and that is just ahead of the SpaceX IPO in the US. And
Yeah.
probably not as a coincidence, as it did, I couldn't imagine. So this is disturbing the Chinese investors a bit, and it actually means that they can hold the account for another 2 years. The typical fair people, as in China, people are fair. They are actually, and also in many cases the governments are fair. But
Mm-hmm.
so people can hold their accounts for 2 years, but they can only sell. They cannot switch shares or whatever. And of course, not buy. They can only sell. But we are talking about 32 billion US dollar. And this is, after all, an amount. And
Yeah.
it's a bit unclear what the 32 billion sort of includes. But as it is focusing on individual clients' trading behavior or trading accounts outside China, then it's sort of from the context seems to be 32 billion.
Mm-hmm.
That is actually neat as of foreign assets, but we don't believe a lot will be sort of simply sold out and the money taken back to China. This is not what we believe. We we think people will shift to the official trade channels, actually. That's
They're
what we
very
believe.
enterprising anyway, so they'll find a way.
But anyway, it's a huge amount, interesting story, and
Mm-hmm.
actually could lead to some Chinese, at least private investment, private investor sell-off here and there in yeah around several markets. But of course, they like the U.S. market. So those probably U.S. assets that are sold out there.
We did talk
But
about Peter that I think it was a few tens of podcasts ago that China wanted to encourage air quotes for emphasis for retail clients in mainland China to invest more or participate more in the domestic stock market. That was framed positively. Maybe this is the alternative strategy to achieve that.
it can be, yeah, but China on the move again all the time. And yeah, interesting to see if we can measure it in the flows in and out of China.
Yes.
Otherwise, as we were talking a bit about U.S. IPO, let's at least jump to the U.S. market. Also with some interesting numbers coming out, and this is about the issuance of convertible bonds, also typical bonds, corporate bonds that have a lower coupon
Mm-hmm.
than they would normally have. But the upside is that the investor is allowed to convert the bond into shares in the company that they invested into, if that is a good idea from an economic perspective. The interesting part with this is we have also during this year had conversations about even the IMF warning about the size of credit as a credit debt, US as a corporations issuing debt, basically, and we've seen the discussion about private debts via credit funds, as a
Mm-hmm.
typical credit funds that are lending out to the private markets, as corporates, as an example, where there have been some losses, and this has been seen as yeah, negative. But we have, as our argument is, as long as not leveraged money uh, that are lost, then of course it's a bad situation, but it is wealth that is decreasing. It is not anything fundamental that is lost. Um, and so we've not been sort of actually not afraid of that part,
Mm-hmm.
that the private lending funds, credit funds, they've lost some money. We do not see a bubble. So this is another story, Mel. The growth and the record growth in the
Mm-hmm.
issuing of convertible bonds is linked to predominantly what we would call information technology. If we would go some definition steps lower, I'm very convinced it would be sort of AI
Uh-huh. Yes.
like companies. And the risk is it is simply just a company that has AI in its name somewhere, and then is where things get really risky. And the bonds are issued by corporations that maybe has a link to AI. This is what you never know. But the force behind, as I is we talk about so far, the first months, 5 months of this year is 30 billion US dollar that has been issued. It is 4 times as much as the sector that is number two. And this is where we say, okay, this could look like a bubble or something we should at least concern a bit about. That is much more concerning than credit funds just how to say it,
Mm-hmm.
raising more money and lending more money out because it's an okay business actually, and it is a bit broader. You also always need to look into your credit fund and see what is the credit fund doing. It can be very specialized, and then of course there will be a certain risk. The issuing of convertible bonds in the US, it's a bit heated market, yeah? Or it can easily be. We sort of raise not a red flag, but we say, okay, hey, look out. There's a lot going on in the market, and people are as the companies are issuing probably on the back of something with AI in the name, yeah. And
There's
this
a lot
is
of speculation over there. You said, yeah, it might be a very good deal for the investor because that's a big if that company that issued the convertible bond does succeed, then they strike big. But otherwise, it's such a gamble as well. And it would be great if they have something to back up their position with, like, do they have a track record, do they have good bottom line, do they have good technology, but otherwise it's hard to tell.
but it's noteworthy, and this is of course some of the many developments in the market that we simply take notice of. They are somewhere on our radar screen.
Mm-hmm.
Uh, we we pay attention. Is it something that this sort of one single piece of data, does it change any outlook for us? No, it does not. But we observe, we notice what's
Definitely.
going on, and say all of a sudden if such a trend is spreading, or if it's just the AI part is just going even further out, yeah, and saying okay, it's solely AI, that of course will let us to say, okay, there's a reason for some action, whatever. Interesting sort of bits and pieces of market happenings, and this is actually
Mhm.
all, but we notice, yeah. Good, Mel. As always, we in the here the last 2 minutes, we will do the global walk around and have a look and see how much sunshine we can see in the financial markets. Is there sunshine at all?
Yes, Peter, of course, we do still see sunshine ahead, although clouds are in the horizon. Of course, one of the biggest still hanging above us is the oil price shock due to the US-Iran conflict. But there are sources of growth and resilience among certain economies that we favor, that the emerging markets, which are proactively and responsively responding to the crisis. Of course, we do see that there could be some increased debt among the countries that we monitor due to some of them offering more subsidies and incentives and tax breaks to smooth out consumption and through this crisis. But yes, that could be concerning, but only if it substantially bloats the debt burden of the economies there. But otherwise, we do see that they're still okay and that there is still domestic growth that's driving our interest towards these markets.
We still remain sort of general positive, and we see the upside in the world, or the financial world, so to say, at least, market. We do increasingly start to think about and act, say, in the way of after the life after the Iran US crisis and high oil price crisis, so to say. This is what we start to focus at.
Mhm.
And we agree. Um, Economies, countries with good flexibility, good domestic demand, fiscal position that is still okay and flexible, they can continue to move forward, and they will do. This is simply what we see. As we are more optimistic on the world than the average, that is for sure, and we still like
Mhm.
risk in different areas. We have not changed. The latest change we did was sort of saying, okay, go even shorter on the yield curve because rates are coming up, but we still like the credit risk, we still like the emerging market risk, we still like also corporate risk, non-listed investment in non-listed companies. And so we are happy. The clouds, yes, but there are also some good ways out there. So that is how we see the world. That's it could be worse. And then we say thank you to the listeners again for listening in, and thank you, Mel, for sharing your insights. It was great as always, and see you next week.
Thank you, Peter.
Thank you for tuning in. As always, we keep a watchful eye on market shakers and movers. Catch the next episode of Sound Economies with Mel and Peter, a podcast by Longines Investor Insights. Available on Spotify, YouTube, and wherever you listen to podcasts. Longines Capital has been in the business of investment advisory and wealth management for over a decade, with our high-performing and multi-awarded funds to show for it. We're taking this to the next level through an IPO in 2 years. Join us in this journey. Visit our website to learn more.